Welcome to Safe Simple Sound Podcast. I am your host, PK. Today we have an exciting episode lined up where we use AI voices to bring insightful discussions to life. But before we dive in, please note this podcast is for entertainment and educational purposes only and does not constitute financial, legal, or professional advice. Investment decisions should always consider your personal circumstances, financial goals, and risk tolerance. Be sure to consult a qualified financial professional before making any investment decisions. If you would like personalized guidance, you can reach out to me at savesimplesound.com/contact. Now, let's get started.
Hey everyone, and welcome back to Safe Simple Sound. Today we're diving into the exciting world of building a stock portfolio. This episode is based on an insightful post titled Building Your Portfolio on safesimplesound.com website, which provides a comprehensive guide for navigating the stock market. It emphasizes the importance of establishing a solid investment foundation, understanding diversification, and avoiding common pitfalls. We'll explore how these principles translate into real-world scenarios, helping you build a portfolio that aligns with your unique financial goals. Now, to map out our journey today, we'll start by laying the groundwork, exploring understanding your investment foundation, where we'll follow the stories of a recent grad, a mid-career professional, and a couple nearing retirement, all at different stages of their investment journeys. Then, we'll move into diversification and asset allocation, discussing the all-too-common scenario of being overinvested in one sector and exploring the benefits of a balanced approach. Next, we'll get practical with building your stock portfolio, practical steps, offering guidance for first-time investors and those looking to refine their existing strategies by incorporating dividends and international exposure. Finally, we'll tackle those crucial, common portfolio mistakes to avoid, with scenarios that highlight the dangers of chasing returns and the challenges of information overload. Get ready for an informative and engaging discussion that will empower you to take control of your financial future. Let's dive in. Welcome back to Safe Simple Sound. In this segment, we're tackling a common dilemma, the recent grad navigating the world of personal finance. Taylor, our learner today, represents many young adults facing student loan debt while also wanting to start investing for the future. Sam, our expert, is here to offer guidance. So Sam, let's jump right in. How can a recent graduate prioritize both paying down student loans and investing for the future?
It's a balancing act, Alex. The first step is understanding the interest rates on those student loans. If they're high, say above 7%, aggressively paying them down might be the best initial strategy. It's like getting a guaranteed return on your money by eliminating that interest. However, even with high-interest debt, it's important to start investing early, even with small amounts, to benefit from the power of compounding over time.
So if I understand correctly, even if my loans have a high interest rate, I shouldn't ignore investing completely.
Exactly. Think of it this way, Taylor. Aggressively paying down debt is a sure win, like a high-yield savings account. But investing, especially for long-term goals like retirement, is where you can potentially see significant growth over time. It's about finding the right balance.
That's a great analogy, Sam. It's like having two engines powering your financial journey: debt reduction and wealth building. Now, for recent grads who might have limited capital, what are some low-cost investment options suitable for beginners?
Fractional shares are a game changer. Many brokers now allow you to buy fractions of a share, meaning you can start investing in even high-priced stocks with a small amount of money. Exchange-traded funds, ETFs, are also excellent. They allow you to diversify across a basket of stocks, representing a particular market segment or index for a relatively low cost.
ETFs sound like a good way to achieve diversification without having to buy dozens of individual stocks. Are there any specific ETFs you would recommend for beginners?
For someone starting out, a broad market index ETF, like one that tracks the S&P 500, is a solid choice. It gives you exposure to a diverse range of large U.S. companies.
That's a good point, Sam. Starting with a broad market ETF can be a simple and effective way to build a foundation. Now, Taylor, imagine you've just graduated and landed your first job. How would you approach this balancing act of debt and investing?
Well, I think I'd first focus on creating a budget. I'd try to allocate extra money each month towards my highest interest loans while setting aside even a small amount, maybe $50 or $100, for investing in a broad market ETF. Even if it seems small, it's a start.
That's exactly the right mindset, Taylor. Consistent contributions, even small ones, are crucial, especially when you're just starting out. The power of dollar cost averaging. Investing regularly helps mitigate the risk of market fluctuations.
Let's recap. For recent graduates, balancing student loan repayment and investing requires a strategic approach. Prioritize high-interest debt, but don't neglect the long-term benefits of investing, even with small amounts. Fractional shares and ETFs offer affordable entry points. And that's our time for this segment. Your call to action. Create a budget that allows for both debt repayment and regular, even small investments. Your future self will thank you. Next, we're focusing on the mid-career professional, someone with a stable income, some savings, and a desire to ramp up their wealth-building journey while ensuring they're on the right track for retirement. How can a mid-career professional assess their current investment strategy and make adjustments to maximize returns? And perhaps more importantly, what are some strategies for balancing risk and reward at this stage of life?
Excellent questions, Alex. A mid-career professional should start by revisiting the fundamentals we discussed earlier: goals, risk tolerance, and timeline. For example, if someone is 10 years away from retirement, their portfolio should look different than someone 25 years out. The closer you are to retirement, the more you might shift towards capital preservation. This is often reflected in a move towards a greater percentage of bonds or other less volatile assets.
So if I understand correctly, even though I'm in my mid-career and earning more, I shouldn't just go all in on high-growth, high-risk investments.
Exactly. Aggressive growth strategies are generally more appropriate for longer timelines. A mid-career professional needs to find a balance. They can still aim for growth, but they also need to protect what they've already accumulated.
This is a great point, and it ties in nicely with our previous discussion about diversification. Think of it like building a house. You need a solid foundation before you add the fancy features. Core holdings, like those blue-chip companies we mentioned, established, stable businesses, can form that foundation.
This reminds me of what we discussed about not putting all your eggs in one basket. So even though I'm focusing on building wealth, I still need that stability component in my portfolio. Could you give some examples of how that might look in practice?
Sure. Let's say someone is comfortable with a moderate level of risk. They might allocate 50% of their portfolio to core holdings, well-established companies in various sectors. Then 30% could go towards growth stocks, companies with higher potential, but also higher risk. Finally, 20% could be allocated to international stocks for broader diversification. This is just an example, of course, and the specific percentages would depend on individual circumstances.
Right? It's important to remember that there's no one-size-fits-all approach. Taylor, let's say you were looking at your portfolio and noticed it was heavily concentrated in the tech sector. What adjustments might you consider?
Based on what we've discussed, I'd probably want to diversify by selling some of my tech holdings and using the proceeds to invest in other sectors, like healthcare or consumer goods. That would help balance my portfolio and reduce my risk.
That's a sound strategy. Diversification helps cushion the blow if one sector experiences a downturn. It's about managing volatility and protecting your overall returns.
So, to recap, a mid-career professional should review their investment goals, assess their risk tolerance, and adjust their portfolio accordingly. This might involve adding more core holdings for stability, diversifying across different sectors, and potentially reducing exposure to high-risk investments as retirement approaches. The key takeaway is to review your current portfolio and adjust your asset allocation to align with your risk tolerance and time horizon. Don't be afraid to seek professional advice if you need help.
And remember, building a successful portfolio is a marathon, not a sprint. Consistency and discipline are key.
This has been incredibly helpful. Thanks for clarifying these concepts.
We're continuing our discussion on building a strong investment foundation, and we'll be focusing on a specific scenario: a couple nearing retirement. Let's say they're in their late 50s or early 60s, looking to transition from accumulating wealth to drawing a stable income while preserving their capital.
That's a big shift, isn't it? Going from focusing on growth to needing the money to actually live on.
Exactly, Taylor. And that shift requires a different approach to investing. Sam, how can a couple nearing retirement adjust their portfolio to minimize risk and generate income?
The key is transitioning from a growth-focused portfolio to one that prioritizes income and capital preservation. This often involves increasing allocation to lower volatility assets like bonds, dividend-paying stocks, and potentially annuities. Remember what we discussed earlier about diversification? It becomes even more critical here. Spreading investments across different asset classes can help mitigate risk during market fluctuations.
So, are you saying they should move all their money out of stocks? Because I remember from previous episodes that stocks have historically provided higher returns over the long term.
Not necessarily all their money. They still need some exposure to stocks for potential growth, especially to combat inflation. But the proportion of stocks should likely decrease. Think of it like adjusting the dials on a thermostat. Less heat, as in risk, more cool air, as in stability. The exact mix will depend on their specific circumstances and risk tolerance.
That's a great analogy, Sam, like adjusting your thermostat for the changing seasons. What are the key considerations for estate planning and legacy building at this stage, Sam?
Estate planning becomes crucial as retirement approaches. This involves creating a will, designating beneficiaries for retirement accounts and insurance policies, and potentially exploring trusts to manage assets and minimize estate taxes. It's also important to consider powers of attorney for healthcare and finances.
This reminds me of what we talked about regarding long-term goals. Estate planning seems like another piece of that puzzle, ensuring your wealth is managed and distributed according to your wishes.
Precisely, Taylor. And a financial advisor can help navigate these complexities. Let's take a practical example. Imagine a couple with a portfolio heavily invested in growth stocks. As they near retirement, they might gradually shift a portion of those holdings into dividend-paying stocks and high-quality bonds. They might also consider allocating a small percentage to real estate or other income-generating assets.
So, if I understand correctly, the idea is to create multiple streams of income, each with varying levels of risk, to provide a stable and diversified income flow during retirement.
Exactly. And it's not a one-time adjustment. They need to regularly review and rebalance their portfolio, perhaps annually or biannually, to ensure it remains aligned with their evolving needs and market conditions, just like you'd rebalance your car tires for optimal performance.
Let's recap the key takeaways for our listeners. For those nearing retirement, the focus shifts from wealth accumulation to income generation and capital preservation. Diversification across asset classes becomes even more important, and estate planning should be a priority. Remember, this is a general overview. Every individual's situation is unique.
So it sounds like seeking professional advice is a really important step.
Absolutely, Taylor. A qualified financial advisor can help personalize your retirement plan, taking into account your specific financial situation, risk tolerance, and goals. We encourage you to consult with a financial advisor to develop a comprehensive retirement plan that addresses income needs, risk management, and estate planning.
Note for listeners, if you need specific guidance, you can reach out to us safesimplesound.com/contact.
We're diving deeper into portfolio diversification. Our scenario today focuses on Swift, an investor who's all in on tech stocks, wondering about diversification and risk mitigation. Sam, our expert, is back to help us unpack this. So, Sam, what are the risks of concentrating investments in a single sector like technology?
Thanks, Alex. Well, as the provided context mentions the airline industry in 2020, any single sector can face unexpected headwinds. Technology, despite its growth potential, is no exception. A regulatory change, a disruptive innovation, or even a sector-specific economic downturn could significantly impact returns. Think of the dot-com bubble burst in the early 2000s, a stark reminder of how concentrated tech investments can backfire.
That's a bit unsettling. I've seen tech stocks perform incredibly well over the past few years, and it's tempting to keep riding that wave. But the dot-com bubble example, that does make me think. So how can diversifying across different asset classes and sectors offer protection during market downturns?
Excellent question, Taylor. Imagine your portfolio as a car. If all your tires are from the same manufacturer and one has a defect, you're in trouble. But if you have tires from different makers, a single defect is less likely to disable the entire car. Diversification works similarly.
Precisely. Let's say a recession hits and consumer spending drops. Tech stocks, often reliant on discretionary spending, might suffer. However, sectors like consumer staples, think groceries and toiletries or utilities, tend to be more resilient during downturns. A diversified portfolio can help cushion the blow by offsetting losses in one area with gains or stability in others.
So if I understand correctly, even within tech, it's beneficial to invest in different subsectors, like maybe not just software, but also hardware, semiconductors, and even cybersecurity. This reminds me of what we discussed about not putting all our eggs in one basket.
Exactly. That's diversification within a sector. And expanding further into different asset classes like bonds, as mentioned in the context, provides another layer of protection. Bonds generally react differently to market events than stocks, offering stability during volatile periods.
To add to Sam's point, the context also highlighted international exposure. Emerging markets, for example, might offer growth opportunities that are less correlated with the performance of U.S. tech stocks. This further diversifies your portfolio and potentially enhances returns.
This is starting to make a lot of sense. So building a diversified portfolio isn't just about picking different stocks. It's about strategically allocating investments across sectors, asset classes, and even geographies based on my risk tolerance and goals.
You nailed it, Taylor. Let's recap. Concentrating investments in a single sector, even a high-growth one like technology, exposes you to significant risk. Diversification across different asset classes, sectors, and geographies is a key strategy for mitigating those risks and potentially improving long-term returns.
And remember, diversification doesn't guarantee profits or eliminate losses, but it does improve the likelihood of achieving your financial goals over the long term by reducing the impact of unforeseen events on your portfolio.
So listeners, what are your takeaways from this discussion? What steps can you take to strengthen your investment strategy? Our call to action is this: evaluate your current portfolio and consider diversifying across different sectors, asset classes, and geographic regions. In this segment, The Balanced Approach, we're diving deeper into the world of diversification and asset allocation. We'll be addressing a common scenario. An investor, let's call her Maria, wants to understand how to spread her investments across different asset classes, stocks, bonds, cash, and maybe even real estate, based on her specific risk tolerance and investment goals. Taylor, are you ready to tackle this with us?
Absolutely, Alex. I think this is something a lot of people struggle with. The previous sections laid a good foundation for understanding stocks, but how to actually combine them with other assets feels like a whole other level.
Exactly. And that's where Sam's expertise comes in. Sam, what's the optimal asset allocation for different risk profiles and investment timelines?
That's a great question, and it's highly personalized. Let's start with a simplified example. A young investor, say in their 20s, with a long time horizon and high risk tolerance, might allocate a larger portion, maybe 80 to 90%, to stocks for growth potential. As they approach retirement, that allocation would gradually shift towards more conservative assets, like bonds, reducing stock exposure to, say, 50 to 60%, or even lower, depending on their individual comfort level.
So, if I understand correctly, younger investors can afford to take more risk because they have more time to recover from potential market downturns. This reminds me of the time in the market concept we discussed earlier.
Precisely. Time is a powerful ally in investing. For someone closer to retirement, preserving capital becomes more important than aggressive growth, so a higher allocation to bonds and cash makes sense.
Let's build on that. Someone with a moderate risk tolerance might aim for a more balanced portfolio, perhaps 60% stocks and 40% bonds, regardless of age. The specific mix would still depend on their individual circumstances, of course.
This makes sense, but what about rebalancing? How does that help maintain the desired allocation over time?
Excellent question, Taylor. Imagine our hypothetical young investor with 80% in stocks and 20% in bonds. Over time, if the stock market performs well, their stock allocation might grow to 90% or even higher, increasing their overall risk exposure. Rebalancing involves selling some of those appreciated stocks and buying more bonds to bring the allocation back to the original 80-20 target.
It's like trimming a garden to keep it healthy and balanced. Rebalancing helps maintain the desired risk level and can even enhance returns over time by enforcing a buy low, sell high discipline.
So, if the stock market dips significantly, you would rebalance by selling some bonds and buying more stocks, taking advantage of the lower prices. This seems counterintuitive, buying something that has gone down, but it makes sense within the context of rebalancing.
Exactly. It takes discipline to buy when prices are down, but it's a crucial element of successful long-term investing.
To recap, asset allocation is about finding the right mix of assets, stocks, bonds, cash, etc., based on your risk tolerance and investment timeline. Rebalancing ensures that your portfolio stays aligned with your target allocation over time.
And it's important to remember that this is personalized. There's no one-size-fits-all answer.
Absolutely. To help our listeners take action, we encourage you to explore online asset allocation calculators and resources. These tools can provide personalized recommendations based on your individual circumstances. You can also research different model portfolios and compare them to your own. Next, we're putting the building blocks in place for our first-time investor, someone just starting their journey into the world of stocks. We've talked about setting goals, risk tolerance, and diversification, but now it's time to get practical. Let's say you've done your homework and you're ready to buy your first stock. What are the steps involved in opening a brokerage account and making your first investment, Sam? And Taylor, I'd love to hear your thoughts as we go along, especially from a beginner's perspective.
Great questions, Alex. Opening a brokerage account is like setting up a checking account for your investments. You'll choose a brokerage firm. There are many out there like Fidelity, Schwab, or Vanguard, and fill out an application online. You'll need to provide some personal information, including your social security number and bank account details for funding. Once your account is approved, you can transfer money in and start investing. Buying a stock is then as simple as searching for the company's ticker symbol and specifying the number of shares or dollar amount you want to purchase.
Okay, so it sounds pretty straightforward online. But how do I know which brokerage is right for me? This reminds me of when we talked about choosing a bank. There are so many options.
That's a great point, Taylor. Like choosing a bank, it's important to compare fees, features, and available research tools. Some brokerages offer educational resources, which can be invaluable for beginners. Others might have lower trading fees or a wider selection of investment options. Doing a little research up front can save you money and headaches down the road.
Exactly. And to Alex's second question, how to identify suitable stocks, a beginner should focus on understanding their own risk tolerance and investment goals. As we discussed earlier, a long-term investor might be comfortable with more volatile growth stocks, while someone closer to retirement might prefer more stable, dividend-paying companies.
So, if I'm aiming for long-term growth, where do I even start looking for potential investments? It feels a little overwhelming thinking about all the companies out there.
Start with the basics. Think about companies you know and use regularly. Do you shop at a particular retailer? Subscribe to a streaming service? These can be good starting points for research. Look at their financial performance, their industry position, and their future prospects. And remember the concept of diversification. Don't put all your eggs in one basket.
Building on that, Taylor, remember our discussion about core holdings? Established companies, often referred to as blue-chip stocks, can be a good foundation for a beginner's portfolio. Think about companies like Johnson & Johnson, Microsoft, or Procter & Gamble. These are generally well-established, stable companies with a long track record.
So, if I understand correctly, I shouldn't just pick a stock because it's popular or because I heard someone talking about it on social media.
Absolutely not. Avoid chasing hot tips or trying to time the market. Investing is a long-term game. Focus on building a diversified portfolio of companies you understand and believe in, companies that align with your investment goals and risk tolerance.
Excellent point, Sam. Let's recap. To get started, you open a brokerage account, comparing fees and features. Then you research potential investments based on your goals and risk tolerance, starting with familiar companies and focusing on building a diversified portfolio. Avoid chasing hot tips and remember that investing is for the long haul.
This has been really helpful. It's starting to feel a lot less daunting now.
Great. And to our listeners, we encourage you to do your own research. Investigate different brokerage options, compare their fees and features, and see which one best fits your needs. This is an essential step before you even think about buying your first stock. Next, we're focusing on refining your stock selection strategy. We're assuming you already have a basic portfolio and are looking to enhance it with new concepts like dividend investing and international diversification. Taylor, as our learner today, what are your initial thoughts on these concepts?
Well, Alex, I've heard the term dividend stocks thrown around a lot, but I'm not entirely clear on how they work and why they're beneficial. Also, international markets seem interesting, but a little intimidating. I'm wondering about the risks involved.
Excellent questions, Taylor. Sam, could you shed some light on dividend stocks and their role in a portfolio?
Certainly. Dividend stocks represent companies that distribute a portion of their profits to shareholders. Think of it like getting a regular paycheck from your investments. This provides a stream of income, which can be particularly useful for long-term investors or those seeking current income. Furthermore, reinvested dividends can fuel significant long-term growth through compounding, essentially earning interest on your interest. A classic example would be a company like Johnson & Johnson, a well-established healthcare company with a long history of paying and increasing its dividends.
So if I understand correctly, dividends are like a bonus on top of any potential increase in the stock's price. That sounds appealing, but what about growth? Are dividend-paying stocks typically growth stocks as well?
Not all dividend stocks are high-growth stocks. Some established larger companies prioritize dividends over aggressive growth. However, many companies manage to strike a balance, offering both dividends and respectable growth potential. It's important to research and select dividend stocks that align with your overall investment goals. For example, a younger investor with a longer time horizon might focus on companies with a history of both dividend growth and share price appreciation.
That's a crucial point, Sam. Taylor, this connects back to our earlier discussion about aligning your investment strategy with your specific goals and risk tolerance, right?
Right. This reminds me of what we discussed about investment timelines. If you're saving for retirement decades down the line, you might be more inclined towards growth stocks, even if they don't offer dividends yet.
Exactly. Now let's shift our focus to international diversification. Sam, what are the key benefits and risks of venturing into international markets?
International diversification provides access to global growth opportunities, many of which may not be readily available in domestic markets. It also helps reduce your portfolio's dependence on a single country's economy. Consider the rapid growth of economies like India and China in recent decades. Investing in international markets allows you to participate in these growth stories. However, there are risks such as currency fluctuations and political instability in certain regions.
Currency fluctuation. So if a foreign currency loses value against the dollar, my investment returns could decrease even if the stock performs well. Right?
Precisely. That's why it's essential to consider currency risk when investing internationally.
A key takeaway here is the importance of research and understanding. Don't just jump into international markets without understanding the specific risks and opportunities associated with each region or country.
So if I were to start exploring international investments, what would be a good first step?
A good starting point could be looking into exchange-traded funds ETFs that focus on specific regions or countries, or even broad-based international ETFs. This allows you to diversify across multiple companies within a particular market with a single investment. We'll be discussing ETFs in more detail in our next episode.
Great point, Sam. That's a perfect segue into our next episode. Let's recap. Dividend stocks can provide both income and growth potential, while international diversification offers access to global opportunities but also introduces currency and political risks. To broaden your investment knowledge, we encourage you to explore resources on dividend investing and international markets. There's a wealth of information available online and in financial publications. In our next episode, Beyond Individual Stocks, we'll delve into the world of ETFs and mutual funds. Stay tuned. Now we're diving into a scenario many investors face: the allure of chasing returns. Imagine this: a stock, let's call it Zoom, has been skyrocketing. Everyone's talking about it, your friends are bragging about their gains, and FOMO, the fear of missing out, is kicking in hard. Taylor, as our learner today, put yourself in those shoes. What's going through your mind?
Oh, I can totally relate. I'd be thinking, everyone else is making money. Why am I not in on this? What if I miss out on the next big thing? It's that feeling of being left behind, especially when you see those eye-popping gains on social media. It almost feels irresponsible not to jump in.
Exactly. That's the emotional trap. Sam, as our expert, can you shed some light on the dangers of chasing past performance and following market hype, as Taylor described?
Sure, Alex. The problem with chasing returns is that past performance is not indicative of future results. Think of it like a basketball player who scored 30 points in their last game. Does that guarantee they'll score 30 points in the next one? Of course not. Market conditions change, company fortunes shift, and what goes up often comes down, sometimes rapidly. Zoom might be hot today, but tomorrow it could be facing unforeseen challenges, like increased competition or regulatory hurdles. The hype often peaks right before the decline.
So, if I understand correctly, just because a stock has performed well in the past doesn't mean it will continue to do so. This reminds me of what we discussed about diversification earlier, not putting all your eggs in one basket. It seems like chasing returns is the opposite of that, right?
Precisely. Chasing returns often leads to overconcentration in a single stock or sector, precisely the kind of risk diversification aims to mitigate.
Great point, Sam. The previous episodes mentioned blue chip companies and building a core portfolio. Those concepts seem relevant here. Instead of gambling on high risk, high reward plays, building a foundation of solid companies can provide more predictable, long term growth. How can investors like Taylor make rational decisions based on sound principles rather than getting swept up by emotions?
A disciplined investment strategy is crucial. This starts with understanding your risk tolerance, defining your investment goals, and developing a diversified portfolio aligned with your timeline. Regularly rebalancing your portfolio, as we discussed earlier, also helps avoid emotional reactions to market swings.
So, instead of chasing the next hot stock, I should be focusing on my long-term goals and sticking to a well-thought-out plan. This sounds a lot like the dollar-cost averaging strategy you mentioned, Alex, where you invest regularly, regardless of market fluctuations.
You got it. It's about consistency and discipline, not trying to time the market or pick winners. Sam, any additional advice on avoiding emotional decision-making?
Consider a counterexample. Imagine investing in a company based on its solid fundamentals and long-term growth potential. Even if its price dips temporarily due to market volatility, a rational investor, understanding the underlying value, might see this as a buying opportunity rather than a reason to panic sell. This is the opposite of chasing returns. It's about recognizing value and staying the course.
Let's recap. Chasing returns can be tempting, but it's a risky strategy based on the flawed assumption that past performance predicts the future. Building a diversified portfolio, sticking to your investment plan, and focusing on long-term goals are far more effective ways to build wealth. Taylor, any final thoughts?
Yeah, I think the key takeaway for me is that FOMO can be a real obstacle to smart investing. It's important to recognize it and resist the urge to make impulsive decisions based on market hype. Doing your own research and having a well-defined strategy are crucial.
Absolutely. So, our call to action for our listeners is this: develop a disciplined investment strategy based on your own research and risk tolerance, and avoid making impulsive decisions based on market trends. Don't let the fear of missing out lead you to actually missing out on long-term financial success. Next, we're tackling a challenge many investors face: paralysis by analysis. Imagine scrolling through endless financial news, comparing countless stock charts, and feeling overwhelmed by the sheer volume of investment information available. This can lead to inaction, preventing you from making any investment decisions at all. Sam and Taylor, I'm curious to hear your thoughts. How can investors overcome this information overload and develop a clear investment plan? And perhaps even more importantly, what are some reliable sources of investment information and advice?
That's me. I get so bogged down in all the data. It's like trying to drink from a fire hose. I'll read one article that says invest in tech, the next says renewable energy, then another says stick to blue chip stocks. It's exhausting. Where do you even start, Sam?
It's a common problem, Taylor. A good starting point is to filter out the noise. Focus on foundational principles, like those we discussed earlier, defining your goals, assessing your risk tolerance, and understanding your investment timeline. This reminds me of the practical example in the Building Your Portfolio section of our companion guide, where Sarah, a 35-year-old, tailored her strategy based on these very factors. Reliable sources include reputable financial news outlets, educational websites like the SEC's investor.gov, and of course, consulting with a qualified financial advisor.
Excellent point, Sam. Just like building a house, you need a blueprint before you start laying bricks. Your financial goals, risk tolerance, and timeline form the foundation of your investment strategy. Taylor, imagine you're saving for a down payment on a house in 5 years. Would you invest aggressively in high-growth, potentially volatile stocks?
Probably not. That feels too risky. I'd want something more stable, even if the potential returns are a bit lower. So, if I understand correctly, I shouldn't be swayed by the latest hot stock tip if it doesn't align with my personal situation.
Precisely. Chasing short-term trends can be detrimental to long-term goals. Diversification, as discussed in the earlier sections, is another key principle. Spreading your investments across different asset classes, industries, and geographic regions helps mitigate risk. Think of it like a balanced diet. You wouldn't eat only one type of food.
A great analogy, Sam. Now, about those reliable sources, it's crucial to differentiate between information and advice. Information is raw data, advice is a recommendation based on that data. Be wary of anyone promising guaranteed returns. Taylor, what are your thoughts on seeking professional advice?
I've been hesitant, honestly. I worry about the cost and whether I can trust their advice. But after listening to you both, I'm realizing it might be worth it to at least get a second opinion on my current plan.
Financial planner can provide personalized guidance tailored to your specific needs. This ties back to our discussion about asset allocation. A good advisor will help you determine the right mix of stocks, bonds, and other assets to achieve your goals.
Let's recap. To combat paralysis by analysis, start by clarifying your financial goals, risk tolerance, and timeline. Then, seek information from reliable sources, differentiating between raw data and personalized advice. Diversification and seeking professional guidance are key to building a successful investment strategy. So, our call to action today is simple yet powerful. Focus on building a solid understanding of fundamental investment principles and seek guidance from trusted financial advisors if needed. Don't let the vastness of information paralyze you. Take control of your financial future, one well-informed decision at a time. And that concludes our deep dive into building a robust stock portfolio. We explored the foundations of investing, from defining your goals and risk tolerance to understanding the importance of diversification and asset allocation. We used the excellent guide Building Your Portfolio as our roadmap, touching on practical implementation strategies like dollar cost averaging and rebalancing, key takeaways for any investor, regardless of experience. I particularly enjoyed our discussion about the recent graduate scenario. Balancing student loan debt with the desire to start investing early is a challenge many face, and I hope our conversation provided some valuable insights. Remember, even small, consistent investments can make a big difference over time. Thank you so much for lending us your ears today. We truly appreciate you being a part of the Safe, Simple Sound community. Leave us a review. We love hearing from you. And don't forget to subscribe so you don't miss our next episode, Beyond Individual Stocks, where we'll explore ETFs, mutual funds, and other investment vehicles. Until then, stay curious, stay informed, and keep the sound of financial security ringing in your ears. This is Alex, signing off.
That's all for this episode. If you found it valuable, don't forget to subscribe to the podcast. For more insights, you can join my newsletter at safesimplesound.com. If you would like personalized guidance, you can reach out to us at safesimplesound.com/contact. Until next time, take care and bye for now.